Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be addressing if you should buy a house in 2020 given the low interest rate environment that we're in right now. So I get a lot of comments and I also get a lot of direct messages on Instagram. Check me out if you haven't already, with people asking me, hey Marco, should I buy a house in 2020? Should I sell a house in 2020? What's the deal? So a lot of my viewers are similar age as me and they're going through a similar buying process as my wife and myself. So they're either looking for a first-time starter home or they're looking for a primary residence that's going to be potentially a forever home to raise a family in. So buying a home is typically the biggest purchase that we go through in our lives, and it's important to make sure that we get it right. So in this video, we're going to cover the 4 basics of buying a home, whether it's now or 10 years from now. These are 4 basics that always apply in my opinion. We're going to talk about low interest rates and the market given the demand and the supply that we're working with right now. And then to finish off the video, I'm going to give you my personal thoughts from a home buyer's perspective because I have been looking at houses for about 3 or 4 years now. So without further ado, I'm just kidding. No, but seriously, without further ado, let's get right into it. So the first portion of this video is going to go over 4 things that sound like common sense, well, because they are. You'd be surprised how many people go into a huge home purchase without having these 4 things in order. So the first one sounds like common sense, it's good credit. So whether you have good credit or bad credit, the better credit you have, the better rate you're going to receive, period. Basically, if you're anywhere from a 740, 750, 760 and up, you're probably going to get the best rate possible given the money down, term, and stuff like that. So this is important because mortgages can last years. Some are 15 years, some are 20, some are 30. And with that interest rate being lower than you would if you would have had poor credit, you're actually going to save a ton of money over the course of the term of that mortgage. So even something as small as 20 or 30 basis points, meaning 0.2 or 0.3%, that can save you tens of thousands of dollars over the course of that mortgage. So some good resources that I look at is mortgagenewsdaily.com. I'm not affiliated with them. And then also bankrate.com, and I'm not affiliated with them either. It just gives you a good benchmark of what rates are. However, it doesn't hurt to shop locally. I would actually get 2 or 3 rates from your local credit unions and banks just to make sure that everyone is giving you the best rate possible on an apples to apples comparison. So the bottom line for number 1 is having good credit. It's going to give you a better score and it's going to make home ownership more affordable, period. Number 2 is having a healthy debt to income. So a debt to income ratio, if you haven't heard of this before, is basically your monthly obligations such as debt, like a car loan, whatever you have monthly obligations on, divided by the monthly gross income. So notice how I said gross. Gross, I don't use gross. Banks use gross. Anyone that's smart and who watches Whiteboard Finance uses net income. So you want to take whatever your obligations are using that divided by your net income. So if you have a $500 car loan and that's it, and your income is $2,500 a month net, you have a 1 to 5 debt to income ratio, which is 20%. So lenders, they typically lend up to 43% of your debt to income ratio, but I would not recommend that. The lower your debt to income ratio is, the better chance you have of getting approved of that mortgage. And what I recommend is taking all of your income, your net income, figuring out what all of your expenses would be for owning the home. So I don't mean just the mortgage. I'm talking about the mortgage, the insurance, the utilities, the HOA, the taxes, the ongoing maintenance. Everything that goes into owning that home should be no more than 30% of your net monthly income. Some people like to use that metric on a 15-year. I may consider a 20 or a 30, and I'll let you know why at the end of this video. So if you haven't used my home affordability calculator that I created myself, that came from this video right here, you can actually get that down in the description and in the comments below. It's very useful and it'll actually show you if you're house poor or not. Number 3 is getting your savings in check and making sure you have strong savings. So I know this sounds like a no-brainer, and I know you can get low or no money down mortgages. For example, an FHA loan for a first-time home buyer is 3.5% down. So if it's a $100,000 house, 3.5% is $3,500. That's very little to get into a home. However, you're typically going to have PMI on anything less than 20 or 15% down. PMI simply stands for private mortgage insurance, and this is basically insurance that the bank is making you pay to say, hey, you have very little skin in the game since you put such little money down and have very little equity. In case you decide to walk away from this house and default, this is covering my butt as the bank. That money does not go towards principal or interest. That is money that is literally being lit on fire every single month. So I recommend putting down the minimum that you can to at least get rid of PMI. In my case, that's 15%, and I'll talk about that later in this video. So you also need to have 3 to 6 months of living expenses put away in case something goes wrong with the home. So my buddy bought a house. Within 2 months, he had to do the roof and HVAC. Those were huge expenses. A lot of people forget about this when accounting for the price of a house. It's not just what the price of the house is and the down payment. It's all that, plus you have to furnish it, you have to update it, you have to make sure that you have money put away for a rainy day, and a lot of people don't account for that. And then finally, number 4, steady job or income. So this one kind of speaks for itself, and it sounds like a no-brainer. So if you're a commissioned salesperson or an entrepreneur and you don't know what your monthly income is every month, some months could be great, some months could be horrible, I would recommend taking an average of as long as you can of tracking those months and figuring out somewhere in the middle, along with if you have a significant other and they make a steady income, that would be a good baseline to work off of. You don't want to take your highest, best sales months and pretend like you make that every month, because you don't. You'd be lying to yourself and you'd get yourself in trouble. So what do I mean by this is, if you don't have a steady job or steady income, home ownership may not be the best choice for you at this point. If you remember in 2008, which actually caused the financial crisis, they were basically bundling up all these crappy mortgages with people that had ninja loans. Ninja loans were basically just no income, no job. If you can fog a mirror, here's a mortgage, right? People had multiple properties. They obviously couldn't perform, especially if they had adjustable rate mortgages. Those rates went up, boom, they were foreclosed upon. They couldn't afford it. So the more money you put down, the smaller your monthly obligation is going to be. So if you are someone that has this unsteady income, you may want to come to the table with more money down to lower that monthly payment. So the second part of this video, and the crux of the whole video, and the reason why I'm getting so many questions about if now is the best time to buy a house, is because interest rates are extremely low and there's very little supply and very high demand. So we're going to talk about low interest rates and also the current state of the market. So the first point is that interest rates are pretty much at all-time lows. At the time of this recording, my wife and I are pre-approved for a 30-year fixed-rate mortgage. I'm going to have you guess what percentage down in the comments below. So typically, 30-year mortgages are 3, 4, 5%. What do you think my wife and I are pre-approved for right now at the time of this recording? So if you left a comment, it is 2.99% on a 30-year fixed, if you can believe that or not. That is very cheap money. At that same bank, a 15-year is 2.79 and a 10-year is 2.59. That is very, very cheap. However, that leads to low rates and that leads to high asset prices. So low interest rates lead to high asset prices, whether it's stocks or real estate. So look at this example. If Mr. and Mrs. Homebuyer take home, 10 grand a month, I'm just using, easy numbers here. If Mr. and Mrs. Homebuyer take home 10 grand a month and they can fit in exponentially more house into their budget because the interest rate is super low, they're going to be willing to pay a higher price for the house because the rates are lower and the money is cheaper, okay? So they can afford more home for the same payment at higher rates than if the rates were higher, is what I mean. Finally, there's low supply and inventory right now. So baby boomers, there's about 10,000 people in the United States that turn 65 years old every single day. These baby boomers are not moving out of their houses, which is leading, at least where I live in Northeast Ohio, to an inventory glut. And this is actually a theme across the whole country, okay? So when you have high demand, low supply, and cheap money, that can only lead to higher prices. Right now in Northeast Ohio, I actually have access to the MLS, and this is all verified. We're at record prices per square foot, okay, which I'll talk about later in the video. Finally, the fourth point is equity. So when we talk about a 30-year mortgage versus a 15-year mortgage, and I'm going to use this as an example, 30-year mortgages don't typically start paying down the principal more than the interest until 7 years into the mortgage. If you look at a 15-year mortgage and you look at the amortization schedule, you can see that the 15-year mortgage starts knocking out the principal from day one. The 30 does not. It takes much longer to actually start knocking into the principal, more so than the interest. So let's look at this for example. If you took out a $250,000 mortgage at 2.99%, so I'm using a real example here, and you paid that mortgage off in 30 years, you're going to pay over the course of those 30 years $128,958 just in interest alone, okay? Not the down payment and the loan amount, but the interest. That same exact loan, if you want to use a 15-year, $250,000 mortgage at 2.79%, to use real numbers, you're going to pay $56,237, okay, in interest alone. So those are two big numbers. The reason for me telling you this is because if you can't make more money in the market or wherever in any return than 2.99, it doesn't make sense to take out the 30-year mortgage, okay? The 30-year mortgage is cheap. However, if you can make anything above 2.99%, you're basically negating what you would have sunk into the walls of your house in equity, okay, with paying cash instead of taking out the cheap money. And if you can beat that 2.99, it makes mathematical sense to invest that money otherwise. So I'm typically someone who wants to have no debt. I want to sleep cheap. I want to be able to live, affordably. However, the crux of this video is if you have the discipline to invest the difference and put down the minimum down payment. So this same bank actually has no PMI on 15% down for my wife and myself. So if I take, let's just say, a $100,000 house, for example, I put down 15%, that means I have an $85,000 mortgage. I'm putting down 15 grand. Now I can take that $85,000 that I have, instead of putting 100 grand into the house or whatever, I have the cheap money, and then I can use that other money elsewhere to make me more money. Thus, not only covering the mortgage, but making me more return. Does that make sense? So to finish off the video, here is my thoughts and perspective as someone who is in the market for a potential residence. I've been looking for about 3 or 4 years now. I have access to the MLS. I used to have my real estate license when I worked in commercial real estate. I've looked at 1 million houses at this point. I know exactly what they go for. So with that being said, these are going to be some metrics for you to actually keep you in check, because a primary residence, numbers get thrown out the window. You look at certain things from an emotional perspective as opposed from a logical and numbers perspective. And you should, it's a house, it's not a gallon of milk, right? So number one is figure out what kind of market are you in. And what I mean by this, there's different types of real estate markets. So where I'm located in Northeast Ohio, it's a very flat market. Okay, housing here pretty much just keeps up with inflation. There's no big booms or busts, okay, except after 08. That was, oh man, I wish I had like way more money in 08. So anyway, if you're in like a San Francisco, for example, you're gonna have big booms and busts, big booms and busts. What this means is, are you buying, when are you buying in that cycle? Are you buying at the top and then selling at the bottom, which would be stupid? Are you buying at the bottom and selling at the top, which would be great? You can rinse and repeat that. Or are you buying at the top and selling at the top, or buying at the bottom and selling at the bottom? So at that point, you wouldn't be making that much gain, right? So figure out what kind of market you're in first of all, and then figure out, are we at the top of the market or at the bottom? Nationwide, we're at the top. Okay, I can tell you that right now. We've had cheap money and asset prices are high when money is cheap. Now, if you look at like Northeast Ohio, for example, very little population growth. No one's going to say, hey, you know what, honey, we're going to get up and move to Northeast Ohio. No one really does that. However, it's a lot of bang for your buck in terms of value from a cost of living standpoint, and also what you get for that cost of living. So those houses will keep up with inflation. So now that we know we're at the top of the market, what I like to do is compare new home prices versus used. So when I say new, I'm not talking about crazy custom build. I'm talking about what are the national builders building these things at. I'm talking well, this may not apply for nationwide or even worldwide audience, but I'm talking about the national home builders that come in where the house is literally delivered on a truck. They put it up in 90 days, right? So I know that's not the best example, and we will compare apples to apples here in the next point. However, if new construction in a nice development is going for like 150 to 175 bucks a square foot, and used prices are at 145 to 150, use that as a benchmark to think to yourself, well, why would I buy the 20-year-old used home that needs a new roof, HVAC, driveway, landscaping, this and that, for 145 bucks a square foot when I can buy the new one for 160, for example. So I like to use that as a benchmark. The third point is basically looking at this from an apples to apples standpoint, okay? Oh, that kind of looks like a butt. I didn't realize that. Apples to butts. No, apple bottom jeans. I have a soft spot for T-Pain. That's when I was in college, man. He was crushing it. So anyway, I'm going to edit this out. Maybe I'll leave it. Who knows? So apples to apples, what I mean by this is you have to look at the finishes, the lots, the acreage, the taxes, the build quality, everything that's going on with the home. You're not buying a gallon of milk here. You have to make sure that when you're comparing two different properties and maybe potentially two different suburbs or two different areas of a city, you know, what exactly are you getting? You know, some may have high crime, some may have low crime, some may have great finishes, some may have, you know, crappy finishes. That's why buying a house is very difficult, because it's hard to make an apples to apples comparison. Your real estate agent will be able to run comps, which stands for comparables, which will show you, hey, houses within a, you know, half a mile radius or even a quarter mile radius within the last 180 days sold for X. It had granite, crown molding, updated bathrooms, etc., and then you can make an apples to apples comparison. And finally, is this a need or a want? So what do I mean by this? So when you're looking at cars, for example, you can say, oh man, I really like that red convertible. That's a want. Or you have 5 kids and you need the minivan. That's pretty much a need at that point. So you have to look at the house in a similar fashion. Yes, we all want the, you know, 3,500 square foot house with the in-ground pool and all that stuff. However, is that a want or a need? Or you can look at it from, do you have a growing family? You know, are you literally bursting at the seams? Do you not have enough rooms in the house to house your family? At that point, that is a need. So at the end of the day, you need to figure out, you know, are you starting a family? Are you moving for a job? Are you relocating? Is this something that needs to happen or wants to happen? I would say in this market right now, given where interest rates are at and given where house pricing is, I may hold off just for a little bit because of everything that's going on with the layoffs and the unemployment numbers, okay? There's mortgage forbearance going on. That's probably going to last about a year. Then you have foreclosure process that happens. So I say if you can wait anywhere from like, I'd say 12 to 24 months from the time of this video, housing prices will most likely correct at that point. And then finally, I know I said this was the last point, but just thinking out loud here, don't force it, you guys. This is a big purchase, and I know that, you know, renting may feel like you're throwing away money every month, or, you know, making your landlord rich. That is not necessarily the case, because you have to realize when you own a home, home ownership is expensive. A lot of people think that a home is an asset. It is not an asset. It is a liability. It is something that takes money out of your pocket from you every month. It is not a rental property that is an asset that brings money in your pocket every month. So at the end of the day, you guys, be smart. Don't force it. It's a big purchase. You have to think about things like ongoing maintenance and landscaping and all that stuff to maintain a home. Don't rush into it, and make sure you watch the beginning of this video with the basic 4 checklist. So at the end of the day, I know this was a mouthful. I know I kind of rambled here, but it's very important when making such a big purchase to have all your things in order. So if you got value out of this video, please share it with a friend who's potentially looking to buy a home. And as always, have a prosperous day. My mic didn't record the first time I recorded this, dude. I'm like smoked. Hopefully it recorded this time. Let me check. Okay, we're good. We're good.